Welcome to the deep dive. Today, we're jumping right into something pretty significant in India's infrastructure story.
Absolutely. We're talking about UltraTech Cement's massive new capital expenditure plan, just announced October 18th, 2025.
It's a huge number,
Yeah.
and it feels like more than just a business decision, right? It signals something bigger.
Definitely. You don't commit this kind of money without some serious confidence in where things are headed,
hmm
especially for the country's growth.
Exactly. So our mission today is to really unpack this RS 10,255 crore investment. What's behind it? What does it actually mean on the ground for infrastructure?
And how they plan to pull it off, technically and financially.
Okay, let's unpack this. So the headline number for capacity, just how big is this jump we're looking at?
Well, the board signed off on Rise 10,255 crores,
Yeah.
and that's earmarked to add 22.8 million tons per annum MTPA of new cement capacity.
22.8 MTPA. Just pause on that. For someone maybe not in the industry, what does MTPA actually translate to? What kind of scale is that?
Right. MTPA is million tons per annum. So 22.8 million tons. Think about the materials needed for, I don't know, multiple major expressways or dozens of large-scale housing projects. It's a lot of physical material capacity coming online each year.
Okay. And adding that to what they already have,
Mhm.
where does that position UltraTech, globally speaking?
It's a big leap. Once this 22.8 MTPA is fully up and running, their total global capacity jumps to 240.76 MTPA.
Wow.
Yeah, which really solidifies their position. They're the second largest globally if you take China out of the equation.
Okay. But this isn't like flipping a switch, right? This capacity takes time to build. When does the cement actually start, hitting the market?
No, it's definitely phased. They're saying commercial production will start coming on stream gradually. The target start is FY28 onwards.
FY28. Okay, that timing feels important. It seems to line up with a lot of projections for when the next big infrastructure push really kicks in.
Exactly. It's clearly a forward-looking strategy timed for that expected demand surge.
Right. Which brings us to the why. I mean, this isn't their first big spend. They've already put in, what, over 50,000 crores in the last 5 years.
That's right. Significant investment already.
So why another 10,000 crores plus right now? Was there a specific trigger? Like, were they running out of existing capacity?
Well, if we connect this to the bigger picture, yes, that's part of it. They were definitely feeling the pinch. Management mentioned that their capacity utilization was already pretty high,
How high?
around 71% in the first half of FY26. And in certain regions, much higher, as we'll see.
Uh-huh.
When you're hitting those kinds of numbers consistently.
You have to expand, or you start leaving money on the table, losing market share potentially.
Exactly. So part of it is reactive, just keeping up. But the scale suggests more.
Right. That size of investment,
Right.
it must be about more than just meeting current demand. There's a bigger vision.
Absolutely. The official line is basically two things. One, yes, grabbing that future growth, especially post-2027. But two, they're explicitly linking it to the national goal of Bharat 2047.
Okay, so aligning directly with that long-term national development vision. That's a strong statement. Did the chairman, Mr. Birla, say anything specific about that alignment?
He did. His comments were really focused on confidence. He framed it as showing deep, sustained belief in the Indian economy and, the scale of its infrastructure plans.
So seeing their investment as not just building factories, but as a catalyst.
Precisely. He talked about energizing local economies, creating jobs,
Uh-huh.
the whole ripple effect across the supply chain. It's positioned as a nation-building contribution, basically.
Okay, that makes sense for the why. Let's get into the where. With this much capital, location strategy is everything. Where is this 22.8 MTPA actually going to be built?
Yeah, this is really interesting. It's highly targeted. The focus is overwhelmingly on the north and the west of India.
Okay.
The north gets the lion's share. We're talking 18.8 MTPA. That's almost 79% of the total new capacity.
79% in the north. Wow. And the rest?
The remaining 4.8 MTPA goes to the west.
Why such a heavy concentration in the north? What's driving that specific focus?
It comes back to that utilization point. That's where the system is under the most pressure right now. If you look at their operating data, particularly for the combined North and Gujarat regions,
Yeah.
utilization has been hitting peak levels. Like in Q4 of FY25, that combined zone was running at 95% utilization.
95%. Okay, so at that point, you're basically running flat out. You can't really meet any surges in demand, and you probably lose pricing power, too.
Exactly, you're maxed out. So this big push into the north isn't speculative. It's about meeting existing and, crucially, anticipated demand, especially with government infrastructure projects really ramping up in states like Rajasthan, Haryana, MP, UP.
Is it strategically placed to relieve those bottlenecks? Makes sense. And how are they doing it? Is it all brand new plants or expanding existing ones?
It's a mix, which is smart, usually faster that way. So the North's 18 MTPA, you've got major greenfield projects, completely new sites, like 3.0 MTPA in Sohor, Madhya Pradesh, and another 1.8 MTPA greenfield in Lalitpur, Uttar Pradesh.
Okay, new builds and brownfield, expanding existing sites.
Correct. And brownfield is key for getting capacity online quicker sometimes. So they're adding significant brownfield capacity too. Examples are 2.7 MTPA in Chhajar, Haryana, and 3.0 MTPA in Pali, Rajasthan. There's also a smaller bit, 0.6 MTPA, coming from an expansion at India Cements Ltd in Banswara, Rajasthan, which they acquired.
Right. And the West, the 4.8 MTPA there.
That part, focus on Gujarat, is all brownfield. They're expanding 2 existing facilities, Kavaya and Wanakbori, adding 2.4 MTPA at each.
Okay, strategic mix of new and expanded sites, heavily weighted north. Now let's talk about the money. RS 10,255 crores. That's a serious amount of cash. How are they actually funding this? Debt, equity?
This is probably one of the most striking parts of the announcement, actually. The entire investment is going to be funded purely through internal accruals.
Entirely. Wow. Okay, just for everyone listening, internal accruals basically means...
It means they're paying for this massive expansion using the cash generated from their own ongoing business operations.
Yeah.
Their profits.
So no new loans, no selling new shares to raise money?
Nope. Zero external debt for this specific CapEx plan. No equity dilution. It really speaks volumes about their cash flow generation. They're basically funding their future growth from their current success.
That's impressive financial discipline. But, playing devil's advocate, does funding such a huge project entirely from internal cash maybe tie their hands a bit? What if some other big opportunity, like an acquisition, came up suddenly? Would they have enough flexibility?
That's a fair question. I mean, it does use up significant liquidity, but management is clearly signaling they believe this organic expansion offers the best returns right now. And they've put financial guardrails in place.
Like what?
Well, look at the cost efficiency. They've pegged the expansion cost at roughly $52 per ton of new capacity.
Okay. Is $52 a ton good? What's the benchmark?
It's very good. It's incredibly lean. Globally, you often see figures closer to, $70, $80, even higher per ton for similar large-scale greenfield or brownfield projects.
Ah, okay. So building it cheap is key.
Absolutely. That low cost directly boosts the potential return. They're actually targeting an internal rate of return, the IRR, of over 20% for this whole project.
20% IRR, that's a strong target for this kind of industrial investment.
It signals huge confidence in their execution capabilities, that they could build cheaper and faster than competitors.
And how do they manage the overall financial risk? I mean, spending billions, even if it's internal cash, adds pressure.
They're keeping a close eye on debt metrics overall. The projection is that even with this spend, their net debt to EBITDA ratio will stay below 1x by FY28.
So keeping leverage very manageable, less than 1x earnings.
Exactly. Staying financially conservative even while executing this aggressive expansion.
Okay, here's where it gets really interesting for me. The technical side, efficiency. You mentioned the total capacity, but the announcement also talks about adding 15.68 MTPA of clinker capacity specifically. Why is that clinker detail and the conversion factor so important?
Right. The clinker strategy is crucial. It hits both cost efficiency and sustainability. Think of clinker as the core ingredient. It's the part that's really energy intensive to produce in the kiln, like the fundamental flour if you're baking bread.
Okay.
To make the final cement product, you then blend that clinker with other materials, things like fly ash from power plants or slag from steelmaking. These are supplementary cementitious materials, or SEMs.
Got it. So the clinker conversion factor tells you how much final cement you're making from each ton of that core clinker flour.
Precisely. A higher conversion factor means you're using less of the energy-intensive, high-cost, high-carbon clinker to produce the same amount of finished cement. You're blending more efficiently with those SEMs.
And UltraTech is aiming to improve this significantly. They want to push their overall clinker conversion factor close to 1.6x after this expansion is done.
And where are they now?
In Q2 of FY26, the ratio was 1.48, so jumping from 1.48 to nearly 1.6. That's a big efficiency gain.
Right. More final product for less core ingredient,
Okay.
better costs, and also a lower carbon footprint per ton of cement produced.
Exactly. It shows a real focus on optimizing the blend, which is key for both margins and environmental performance in the long run.
So putting it all together, this deep dive reveals a strategy that's, well, aggressive in scale, but also quite calculated,
Yep.
targeting specific high-demand regions,
Yep, the North and West,
funding it entirely from their own cash flow,
showing that financial strength.
executing it at a really low cost per ton,
That $52 number.
and building in efficiency gains through better clinker conversion. It feels like a very focused bet on that post-2027 India growth story. So what does this all mean? Look, this latest expansion, financed internally, laser-focused on the tight North and West markets, and built on efficiency principles. It basically cements UltraTech's position, pardon the pun,
Ah, nice.
to really capitalize on that infrastructure boom we expect to see accelerate from FY28 onwards. They're getting ready now.
It definitely looks like they're preparing for a major wave of demand. Okay, so here's a final thought, something for you, the listener, to ponder. We see UltraTech pushing towards this massive 240.76 MTPA capacity, with a huge chunk landing in the North and West starting around FY28. How quickly do you think that surge in supply will shake up the competitive dynamics there?
Good question.
Will it force smaller regional players into consolidation? Or is UltraTech's efficiency edge so strong that they can maintain premium pricing even with all that new capacity hitting the market, that competitive tension? That's what we'll be watching over the next few years.